Welcome to 10 Minutes of Wealth, the show that makes you smarter about money. Let's get into it. Episode 16, The Intelligent Investor by Benjamin Graham. What if the biggest risk in investing is not the market, but your own behavior? In The Intelligent Investor, Benjamin Graham introduces a timeless approach to building wealth through patience, discipline, and rational thinking. This book is often seen as one of the most important guides to investing ever written. Benjamin Graham was an economist and investor, widely known as the father of value investing. His teachings have influenced some of the world's most successful investors, including Warren Buffett. In this episode, we explore the core message of this book and how its principles can help you make calmer, more confident financial decisions. The core idea. Successful investing is not about beating the market, but about managing your behavior and making decisions with a margin of safety. Graham explains that the market is not always rational. Prices move up and down based on emotion, speculation, and short-term noise. As he famously wrote, the investor's chief problem, and even his worst enemy, is likely to be himself. Before we dive into the lessons, ask yourself, when markets move sharply, do you stay calm and follow a plan, or react in the moment? Key lesson number 1. Mr. Market serves you. One of Graham's most memorable ideas is the concept of Mr. Market. Imagine you own a small business, and every day a partner shows up offering to buy your share or sell you his. Some days he is optimistic and offers a very high price. Other days he is anxious and offers a very low one. Graham uses this story to show how the stock market behaves. Prices move constantly, but those movements often reflect motion rather than real value. The key is how you respond. You do not have to act on every price you see. You can simply observe and wait for moments when the price actually makes sense for you. For example, imagine checking your portfolio and seeing a sudden drop. It feels urgent. It feels like you should do something. But through Graham's lens, that drop is just Mr. Market having a bad day. His mood changed. The underlying business may not have. Over time, this idea changes how you see the market. You become more patient, more selective, and more in control of your decisions. Key lesson number 2. A margin of safety protects your downside. At the heart of Graham's philosophy is one simple idea. Always leave room for error. He calls this the margin of safety. It means you only invest when the price of something is clearly below what it is truly worth. Why does this matter so much? Because the future is uncertain. Even when your analysis is solid, things can change. It protects you when reality does not unfold exactly as expected. Imagine buying a house worth $300,000, but you're able to purchase it for $220,000. That gap is your protection. Even if your estimate was a bit too optimistic, you still have room before you run into real trouble. Graham believed this principle was the central concept of investing. As he put it, the margin of safety is always dependent on the price paid. The lower the price compared to value, the stronger your position becomes. This approach changes how you make decisions. You stop chasing excitement and start looking for solid ground. Not every opportunity qualifies, but the ones that do offer both potential and protection. Key lesson number 3. Discipline drives investment success. Graham makes it clear that successful investing is less about knowledge and more about behavior. You can understand markets, read financial statements, and still make poor decisions. He saw this pattern again and again. Investors buy when prices are rising because it feels safe. They sell when prices fall because it feels uncomfortable. Over time, this leads to a simple but costly cycle. Buying high and selling low. The difference comes down to discipline, having a plan and sticking to it, deciding in advance how you will invest, how you will respond to market swings, and how you will manage risk. For example, imagine the market drops sharply over a few weeks. Headlines turn negative. People around you start to worry. Without a plan, it is easy to follow that fear. But with discipline, you pause. You return to your strategy. You act based on principles, not pressure. When you build discipline, you create distance between emotion and action. And in that space, better decisions begin to take shape. 3 questions to reflect on. Let's pause for a moment and think about how Graham's insights apply to you. 1. How do I react when the market moves sharply, and what does that say about my current approach? 2. Do I invest based on clear value and a margin of safety, or do I follow prices and momentum? And 3. Where in my financial decisions could more patience and discipline make the biggest difference? You do not need perfect answers, just honest ones. If you like, pause this episode for a moment, think them through, or carry them with you as you go about your day. Putting it into practice. Let's look at how you can apply the ideas from this book in your daily life. First, start by thinking like a business owner. When you consider an investment, focus on what the company is actually worth, not just the current price. Second, build in a margin of safety. Only invest when there is a clear gap between price and value, so you give yourself room for uncertainty. Third, create a simple investment plan. Decide in advance how you will invest, how often, and how you will respond when markets move. Fourth, limit how often you check the market. The more you watch every movement, the easier it is to react emotionally instead of rationally. And finally, stay consistent. Small, disciplined actions repeated over time often matter more than big, one-time decisions. Final thoughts. The Intelligent Investor teaches that successful investing comes down to one thing: staying rational in a world that often is not. By focusing on value, building in a margin of safety, and staying disciplined, you give yourself a strong foundation for long-term success. These ideas have guided investors for decades, and they still hold up today. They offer a calmer, more grounded way to approach money, and they can do the same for you. Just remember, the market will always move, and emotions will always follow. But your results depend on how you respond. And maybe the real edge in investing comes from mastering your own behavior. Thank you for listening. You just got smarter about money in under 10 minutes. If this episode was valuable to you, you can support us by buying a virtual coffee via the link in the description. Don't forget to subscribe, and I'll catch you in the next one.